In this video, we're going to look at pricing a little bit more detail. I'll look at some modern types of pricing tools, one in particular, and then we'll start to move into talk about some strategies, how we use options. So the first thing we want to talk about before we get to actual formulas or tools is talk about a concept called the Put-Call Parity. Since all of these assets are related, right? All these, a put and a call can be related to the exact same stock. And of course, an alternative investment to buying a stock would maybe be buying a risk-free type of a bond. So what exists is a concept called the Put-Call Parity. And essentially it relies on this formula here at the bottom where it says the value of an investment in a put and a call, or a put and a stock, have to be equal in value to an investment in a call plus an investment in a risk-free bond. And you can solve for any of those formulas with some very simple algebra. So a put would be equal to a call plus a risk-free bond minus the stock. And this concept basically talks about or alludes to a theory or a characteristic of investment that's called arbitrage. And arbitrage is a situation where you can invest money where you can make a return without investing any money. So obviously that sounds like you shouldn't be able to make any money if you don't have any skin in the game, if you're not making an actual investment. So in theory, arbitrage can exist, but in reality, it is traded away. So if this concept holds, and it does hold in reality, then basically what we have is this construct or this formula that we can utilize to even solve for values of securities, or we can create a security without actually buying the security, right? You can create a stock investment if you buy a call, if you invest in a risk-free bond, and you write a put, right? So we plus on the call, plus on the risk-free, minus on the put. So again, we don't have to get into too much detail about the theory here. This mechanism has to hold, or we can have some problems with pricing. And what you can see here is the illustration of that. We have two portfolios. We have a put for $50 and a share of stock, right? And here's the price of the stock. So if you put those two together, it has a $50 value. We have another portfolio, a call on that exercise price, and a bond investment that would be worth $50. So at $35, it doesn't matter which portfolio you own, they're both $50. And as you see going down the line, it remains $50 until we get above the exercise price. And then above the exercise price, the value of this is essentially the exercise price. Or excuse me, is the price of the stock. So the exercise price is $50 at $55. The value of Nick's portfolio is $55. And the value of Nora's portfolio is $55. So again, they're always equal, which is what the put-call parity is all about. So what drives option prices? There are really two parts to the price. There's the intrinsic value that we've talked about a little bit in the past, but there's also the time value. So the time value is the amount by which the price exceeds its intrinsic value, right? So the market price is always going to be higher than the intrinsic value, unless obviously it's right at expiration. So how does this work? Or essentially, let's look at the example here. I think this makes sense. The stock price is $71.75. It has a strike price of $65. So the market price of the option is $7.69. The intrinsic value is the difference, $71.75 minus 65. The intrinsic value is $6.75, but the price is $7.69. So what that means is there's something else to account for the price, and that's what we refer to as time value. Well, the way I kind of like to think about time value is you are essentially, in quotes, making a bet that there's going to be a change, right? Well, if there is a change, time is on your side. So the longer the time that's available for the stock price to change to the other side of the strike price, the greater the value of this bet. And as time declines, this time value disappears. So that at exercise, the market price and the intrinsic value have to be equal at expiration, right? So again, there's a lot of things we need to kind of fill in here, and quite frankly, this class isn't set for really trying to understand how this all works. It's fairly theoretical and a little bit on the deep side. So the value of an option also is greater if there's uncertainty in the stock price. If the stock price moves a lot, then that means there's a greater chance that it will move in a direction that's good for your investment. So the greater the volatility of the stock, the greater the value of the option or the price of the option. Interest rates are also important, right? The value of a call is going to increase when the risk-free rate increases, and the value of a put falls. Excuse me. With rising interest rates. So they move in opposite directions because, again, the investments are opposite investments, if you will. One is an idea of price rising, the other of price declining. But interest rates in the economy have an impact on value. So let's put these all together to kind of understand what are the things that influence the price of an option. The first thing is obvious. It's the price of the underlying financial asset. The second thing, again, I hope is kind of should be intuitive, right? It's the strike price. But the next three things we have to think just a wee little bit about. And I guess the question here is, if you make an investment, will the change in this variable have a positive or negative effect on your investment, on the value, on the price? The amount of time remaining to expiration. As time declines, the value of the option is going to decline till it gets to the exercise price at expiration. Volatility, we've already talked about. The more volatile, the higher the value of the option will be, whether it's a put or a call. And of course, the risk-free rate, we also talked about how that has influence on investing in general. And since one is a positive investment and the other is more of a negative, like a short sale kind of thing, they work opposite of each other. Now, the one thing we haven't talked about is dividends, right? If a stock pays a dividend, and that dividend will occur during the lifespan of this option, it will have an influence. So options with higher dividends will have lower call values, because if you buy a call, you don't get the dividend, and it will be higher for put values. So dividends also have an influence on the value of a put or a call, but only if a dividend payment is likely. So next, let's look at a theory. This is what's referred to as the Black and Scholes option pricing model. It is a pricing mechanism for a European call. Remember, a European call is a call that only expires or can only be exercised at expiration date. Now, there's some theories that, again, we really just can't get that deep into the relationship between American calls and European calls. But for the most part, we can say that in general, a person would never exercise an American option prior to the date of exercise. If they wanted to get rid of the investment, they would sell it before they would exercise. And the reason they would sell it is because it still has time value. So you don't want to leave any money on the table. So here is this formula, and it's a fairly complex formula that in the end involves some rather high levels of calculus, but we don't have to do the calculus because we have the simplified formulas. So the value of a call is the stock price. Now this ND1, this is a number that represents a probability. And we'll talk about what D1 here is, but this is just the probability of the stock price happening minus, now here's the present value of the exercise price, again multiplied by the probability that that exercise price happens. So this really is just a picture of intrinsic value. It's the stock price minus the exercise price. But it applies this statistical measures that incorporate the characteristics of the variables that we've talked about previous. So let's look at how we calculate D1 and D2. And again, you can see it's a fairly complicated formula. S divided by X is the stock price divided by the exercise price. R is the annual risk-free rate. Standard deviation is the standard deviation of the stock, and T is time. So if you remember, we had 5 variables that influence the value of an option, and those things are all identified in this formula. So once we calculate this formula, D1 and D2, we then convert them into probabilities. And that's done through something called a standard normal distribution function. And if you have a statistics book, you can look these numbers up in those tables. But if you're in Excel, the formula is to find the normal distribution of D1, the formula is equals norm dist, and then in parentheses, you put the number D1. That will give you the solution for this problem. So let's take one little step and talk a little bit about trading before we move on to the next video. Why do people buy options? There are really 2 basic reasons for buying options. The first one is listed here, is buying for speculation. You have an understanding of an investment and you think you know where the investment is going to go. So you place a bet or a purchase just like you would the stock. If you think the stock price is going to go up, you buy a call. If you think the stock price is going to go down, you buy a put. On the other hand, if you just don't think anything's going to happen, or if you think an opposite thing would happen, instead of, if you thought the stock price was going to go down, you could write a put. You could write a call. A person would buy the call, thinks it's going to go up. You're selling the call, so you think the price is at least going to stay the same or go down. So again, on investments, you can leverage your rate of return. And of course, the person that buys the option can only lose the value of the option, which is always less than the underlying stocks. So again, we can leverage returns, if you will, and minimize the ultimate downside losses in an investment. So here is an example of speculating with a call. We have a stock price of $49, and if you bought that stock for $49 and in 6 months later it went to $65, you would earn $1,600, which is again a 33% holding period return. Now that's not annualized, that's just the holding period return. On the other hand, if you bought a stock with a strike price of $40, how would that influence your investment? Well, when you bought it, it would cost $1,100. And again, they have some assumptions down here on the variables. So this is a legitimate price. You would pay $1,100. In 6 months, if the stock went to 65, the expected price of the calls would go to $2,500. And of course, you would then, sell the stock. Once you did that, so you the price you sell the calls for $2,500. It's $1,100, so your profit's $1,400. $1,400 on a $1,100 investment is 127%. If the strike price was $50, again, we know that the market price of the call is going to be a little bit less as the strike price goes up. That's $530. Again, the exercise price, so the ultimate price of the call would be $1,500. So you'd make $970 on a $530 investment. And of course, there's the leverage factor of 183%. Now, the other reason why people buy options is a process called hedging, or trying to reduce risks of their investments. So a hedge is a combination of two or more securities into a single position for the purpose of reducing risk. So it always involves two transactions. A transaction with a common stock, so you're either going to buy or sell short, and then there'll be the simultaneous or subsequent purchase of an option. So protective puts is a way to limit capital losses. You buy a put and you hold an appreciated stock. So what are you worried about happening if you have a stock that has made profit? You want to keep the investment, you want to maintain ownership, but you're worried about losing value. If you buy a put, if the value goes down, the put is going to go up in value for every dollar that the stock price went down. So buying a put is kind of an insurance policy so that the stock, so you won't lose value on your investment portfolio should prices move in the wrong direction. So how would that work? Purchase of the price is $25. The purchase of a put here would be $1.50. If the price goes up to $50, the value of the put would be 0. The 100 shares would be 50 minus, so you'd make $2,500 on the shares, but you lost the premium on your bet, so that means you made $2,350. If the price goes down, though, again, this is what we're trying to protect. The value of the put is $15. The stock price is $10. So what's the value of the stocks? You lost $1,500 on the stock, but you made $1,500 on the put. And of course, the net thing is you also have the cost of the put. So in the end, I think this looks a little bit different here. This says loss. So you would actually lose $150 with this transaction. I would have rather had a negative sign there to make the math a little easier to see. So in this case, we were able to protect the value of this stock, and the only cost was the cost of the investment in the option itself. So I look forward to seeing you in another video.